Hi there everyone, welcome to a special Christmas edition of the Traders Circle Weekly Market Update. Today is Tuesday, the 19th of December. Yes, it's already the 19th, can't believe it, and it is 2023. Now before I get into it, you do need to be aware that what I say is general advice only. It does not consider your personal financial circumstances, and you have to decide if what I'm saying is appropriate for you. What a crazy rally we've seen. In the past 6 weeks, since the end of October, we've seen the Australian market rise over 10%. We've seen the US S&P 500 rise more than 15%. German markets have rallied to their all-time highs. Japanese markets rallied to 30-year highs. All around the world, people have hit the buy button, and why shouldn't they have? They've pretty much got everything they could ask for. We've seen central bankers pivot towards a more dovish stance, and it was a complete about-face from them. In fact, you could say they've probably got egg on their face with how quickly they've turned. You've got that. You've got the fact that we're heading into a cyclical bullish part of the year. Traditionally, December is a pretty positive month for the market, and November can be quite positive, especially if it comes after a negative October. And also, we saw record levels of short interest, at least on the Australian market. The amount of shorts on our market in October and early November are about as high as they've been in dollar terms, I believe, ever, and in percentage terms, certainly way up there. And when all that short interest coalesces, all comes together, it becomes very hard for things to keep falling, and it becomes very easy for things to keep rising. Now, a lot of those shorts have been squeezed out of the market over the past month, and that's definitely added to the pace of gains for our markets. Definitely added to the really steep upwards spike that's occurred. And a lot of it is simply been people who are betting against the market having to close those bets. So our market, the US market, all of them are within striking distance of their all-time highs. So we've got the S&P 500, that's about 1.5% away. Our market is probably closer to sort of 2.5–3% away, I believe, at the current level. So really looks like we're going to finish the year close to the all-time high levels. I'm not really sure that these levels are justified, and I say that because last time we were at these levels, interest rates were much lower. I think the earnings outlook was a lot more positive. And this time around, interest rates are a lot higher, even though they're forecast to come down, and the earnings outlook isn't quite as strong. Looking at our own market, iron ore was north of 200 US a ton back then. It's back around 130 at the moment. At least bank profitability has improved here, but overall, I think the valuations now don't look quite as attractive as they did last time we were at these levels. Doesn't mean we won't continue, doesn't mean we won't see fresh highs reached soon. I do think just from a mathematical perspective, the prices are starting to get a bit stretched. One thing I did want to talk about this week are the commodities prices. So we've seen oil prices rebound a little bit over the last couple of days, and that's occurred with some Houthi attacks on ships in the Red Sea. And that's caused BP and maybe some others to start looking to send ships around Africa instead of through the Suez Canal. So that's pushed the price of oil up. It's going to be a lot more expensive to ship things. It's going to, basically slow down the oil supply chain for that part of the world, and it's going to cause a bit more oil demand as well. So overall, that has caused oil to come off its lows a little bit. If you haven't filled up for the Christmas holidays, I suspect you probably want to do so now, because the moment that schools go off, you will start seeing higher prices at the bows, I believe. So with oil coming back up, we've seen some of the oil stocks start to bounce a little bit. Woodside's been up the last few days. Karoon Energy has started pushing higher. Santos was already up there because of an expected merger with Woodside. So a little bit of signs of life in the oil price. And that could cause a little bit of revisionism around interest rate cuts next year as well, just as people sort of reprice their inflation outlook just a little bit. That will also depend on how long that sort of the Red Sea has issues. So if it's fixed immediately, then oil should come straight back down. If it takes a bit longer, we could see oil rise for a little bit. The other thing I wanted to talk about was iron ore. If you look at the iron ore stocks, you'd be forgiven for assuming that iron ore was trading right back at its all-time highs. Believe it or not, iron ore is actually quite a way off its all-time highs, and for the past week or so, iron ore futures have been dropping. that hasn't stopped those iron ore miners from continuing to push higher. And in fact, a lot of that, I believe, points to the short squeeze I was talking about earlier. Before the sort of events of, early November, late October, short interest on those iron ore miners was pretty much at the highest it's ever been. And with that short interest, it becomes, very difficult, one, for things to keep falling. You need, organic selling, people who aren't shorters selling their shares. And then two, when the price does turn, a lot of those shorters have to very quickly go out and buy those shares. And that's pushed those iron ore miners up and up and up and up. And they've even rallied across the past week, despite the fact that iron ore has fallen, and despite the fact that the Australian dollar has risen over that time. Two things, that basically should decrease their profitability, yet the share prices have kept going. So a massive short squeeze on those iron ore miners, and I think there was very, very large amounts of institutional short interest on those miners that's been squeezed out over the past week. Finally, did want to talk about a weird of the week, and this weird of this week is Zoom being delisted or taken out of the NASDAQ 100 index. So Zoom obviously came to prominence during the global pandemic, became a very, very large company as much working from home occurred. People needed to communicate with their colleagues, with their employers, with their employees, and Zoom became massive. However, things have changed a little bit. There's a lot more competitors, Google Meets, Microsoft Teams, all those sort of things. And, on top of that, people are starting to come back to the office. People are starting to find other things, and they perhaps also haven't been able to commercialize it, turn it into hard dollars as much as they'd hoped. So to me, this really marks the end, and I should say, one of my colleagues, Alfred, sort of suggested this. This does sort of mark the end of the post-pandemic market. The market that we had immediately after the pandemic, where these sort of tech unicorns became the number one thing, Zoom being, chief amongst them. And it was sort of forecast that, these guys would grow at, compounding rates ad infinitum, forever, commercialized to infinity. It just hasn't been the case. And as a result, they're dropping out of the NASDAQ top 100 index. So real sort of a sign of changing times, perhaps. And like I said, perhaps a bit of a marker that we're moving out of that post-pandemic market into something new. Alright guys, so we'll look at the charts for this week, and like I said, the Australian market is starting to approach the all-time highs again. For our yearly high, we're looking around sort of 75.50. That was achieved in February, after a similar but not quite as steep sort of run through January. And if we can eclipse that, we'd be looking at the all-time high right around 7,600. Like I said before, last time we got to 7,600, interest rates were significantly lower than they are now. Iron ore prices were significantly higher. So whether we get there this time around or not, it's a bit hard to say, and I wouldn't be surprised to see some profit taking soon. But, at the moment, definitely still looking super positive from a momentum perspective. For the US market, they're actually a lot closer to their all-time high. Their all-time high is at 4,800 on the S&P 500, and that is, roughly 1.5% away, perhaps even less at the moment. So not far at all from the all-time high for their market, and that was set right at the same time as our all-time high in early 2022. Already the Dow Jones has reached an all-time high, although their NASDAQ is a little bit of a way off its own all-time high. Overall, extremely bullish momentum in global markets. Things are looking a little overboard in the short term though. Nothing can rise or fall forever. You do generally see some mean reversion, some profit taking in this case, and I wouldn't be surprised to see that soon, given how far we've run up across the past few weeks. I do think the steepness of this rally as well points to a bit of short squeezing after a record amount of short interest in our market. So I will wrap it up there for this week, guys. Hopefully you enjoyed. If you did, click subscribe. If you didn't, click it anyway, because it would really help us out a lot. I hope you guys have a Merry Christmas and a Happy Holidays.